let's just dive right into this explainer, guys. We're going to look at a massive financial shockwave that, honestly, might just be a massive warning sign for all of us. Welcome in, everyone. Today, we're unpacking a fascinating and, frankly, deeply cautionary tale. We're talking about a sudden, dramatic market crash that happened literally on the other side of the world. But here's the catch. It has absolutely everything to do with the tech we use every single day, the current AI boom, and the hidden structural plumbing of our very own stock market. So we have to start with a pretty crucial question. What if a catastrophic market crash, happening 6,000 miles away, is actually a sneak preview of our own? It's really easy, to just glance at international news and assume it operates in a total vacuum, like it doesn't affect us. But global finance is this incredibly interconnected web. Think about it like a bridge. If a bridge collapses in one city because of a specific design flaw, and your city has a bridge built with that exact same blueprint, you're going to pay attention, right? Well, that is exactly what we're looking at today with South Korea. To really understand this threat, we first have to look at the staggering highs of the Korean market from just a few short weeks ago. That brings us to Section 1, the Korean stock phenomenon, the illusion of endless gains. The sheer, almost unnatural scale of Korea's boom compared to the US is just staggering. While the US S&P 500 had a very respectable 24% gain over a 12-month period, the Korean stock market, the KOSPI, surged nearly 200%. 200%. It was literally the world's best performer. But, and this is a big but, this wasn't some broad, countrywide economic victory. It was driven almost entirely by just two tech giants. We're talking about Samsung, which rose over 500%, and SK Hynix, which skyrocketed a mind-bending 1,000%. And that right there reveals the fatal flaw. It was a dangerously concentrated market. Just those two companies, Samsung and SK Hynix, ended up making up over 56% of the entire Korean stock index. Imagine that for a second. More than half of an entire nation's stock market riding on the shoulders of just two businesses. If they win, sure, everyone wins. But if they stumble, well, there's absolutely no safety net to catch the broader market. Now, fueling this massive fire were 14 million everyday retail investors. In Korea, they're famously known as ants. Individually, they're small, sure, but collectively, they're a massive market-moving force, making up literally 1 in 4 South Koreans. What's heartbreaking but absolutely critical to understand here is the why. Young Koreans felt completely priced out of the housing market. They looked around and viewed the stock market as their absolute last chance to build wealth. So they didn't just invest their savings cautiously. No, they went all in using massive, incredibly dangerous leverage. We're talking taking out personal loans, borrowing against their future salaries, and pouring cash into high-risk, double and triple leveraged ETFs. At the peak, they'd poured roughly 10 trillion won into leveraged funds, essentially betting the house on just one single company. So the crucial takeaway is that these investors were effectively betting their lives on one massive number, $725 billion. That's the projected 2026 AI infrastructure spending by U.S. tech giants. Think about Microsoft, Google, Amazon, Meta. They already spent $376 billion on AI infrastructure in 2025, and they are on track to hit that mind-blowing $725 billion mark by 2026. Because Samsung and SK Hynix absolutely dominate the production of the specific memory chips required for all these AI data centers, a huge chunk of that American cash flows directly across the Pacific to them. So the Korean ants weren't actually just betting on domestic tech. They were essentially betting their financial futures on the American AI spending spree never, ever ending. But you know how these things go. When U.S. memory stocks like Micron suddenly stumbled in late June, the floor completely fell out. Which brings us to Section 2, Anatomy of a Doom Loop, the reality check. Because the KOSPI had morphed into essentially a two-stock market, that late June sell-off in American tech acted like a spark in a powder keg. It triggered what's now known over there as Black Tuesday. The KOSPI plunged 10% in a single brutal day. To put that into perspective for us here in the States, a 10% drop is the equivalent of the third worst day in U.S. stock market history. Samsung and SK Hynix, they plummeted over 9% instantly. The bubble had officially popped. Now here is exactly how a bad day violently accelerates into a full-blown doom loop. It's a vicious, purely mechanical cycle. Step 1, stock prices fall. Step 2, because those 14 million ants borrowed money to buy their stocks, their brokers suddenly issue margin calls, demanding they deposit more cash immediately to cover the losses. Well, when they can't, the brokers just forcibly sell their stocks to recoup the loan. Then, step 3, all that forced selling floods the open market, pushing prices down even further, which, you guessed it, triggers even more margin calls. Finally, step 4. Remember those leveraged ETFs we talked about? By their very mathematical design, they have to rebalance at the end of every day. That means they are blindly, mechanically forced to sell off assets into an already free-falling market. The human cost of that cold mechanical loop was just staggering. Almost overnight, 320,000 individual brokerage accounts were completely, utterly wiped out. In total, 1.2 million accounts. Guys, that is literally 1 in every 30 people in South Korea hit margin call thresholds. Over 3 trillion won in investments were automatically, forcibly liquidated. These were not people who just got scared and chose to sell in a panic. The computer systems literally sold their life savings for them at the absolute bottom of the market. And of course, this wasn't just isolated to accounts in Seoul. The shockwave instantly became a massive contagion event. We're talking over $600 billion, completely erased across Asian markets. It slammed Japan, Taiwan, Hong Kong, and China all in a matter of just 48 hours. Because when leverage unwinds like that, it really doesn't care about international borders. This is where our explainer takes a pretty cautionary turn. Section 3. U.S. markets, the bigger twin, looking in the mirror. Because we share the exact same structural vulnerabilities as South Korea, just on a much, much larger scale. Just think about these structural risks we have right now in the US. We're currently sitting on the highest margin debt ever recorded as a percentage of our GDP, a massive 4.5%. To put that into perspective, that actually surpasses the peaks of the dot-com bubble in 2000, the housing crash in 2007, and even the meme stock craze in 2021. And by the way, that's just the official number. It completely ignores the hidden leverage lurking around in ETFs, wild options trading, and private credit. Plus, on top of all this borrowed money, we're staring down a massive flood of IPOs scheduled for 2026 that's projected to hit 12% of GDP in post-IPO market cap. The 1999 dot-com peak? That was only 5%. And remember that incredibly dangerous market concentration we just saw in Korea? Well, the US market is ridiculously top-heavy right now, too. The top 10 stocks make up 36% of the entire S&P 500. So out of 500 major companies, just 10 of them are holding up more than a third of the entire market's weight. And guess what? Almost all of those top 10 companies are making the exact same massive foundational bet on the future of AI. It means we are currently trapped in what our source material calls the AI spending loop. And it goes a little something like this. Unprofitable AI companies, think your OpenAIs or Anthropics, create a ton of hype. That hype justifies massive infrastructure spending by the big hyperscalers like Microsoft and Google. That massive spending then justifies the skyrocketing earnings of the chip makers who supply them. And finally, those chip earnings justify the inflation of the entire stock market. It's this perfectly interconnected cycle of financial justification. But the scary part? It is entirely built on and funded by absolute record levels of borrowed money. Which brings us right to the climax of this explainer, Section 4, the ultimate tipping point, the linchpin of the bubble. So if you really want to know when the music stops, there is one absolutely critical metric you need to watch over the next year: capital expenditures. I'm talking about the actual physical cash being spent on servers, chips, and data centers by Microsoft, Google, Amazon, and Meta. Seriously, if just one of these hyperscalers announces they're cutting back their AI spending, it could trigger a massive, uncontrollable unwind across the entire global tech sector. And honestly, there's a very good reason they might cut that spending soon. Famed investor Jim Chanos, you might know him as the guy who famously called the Enron collapse, points out a pretty terrifying trend. The actual financial return on all that massive AI spending is plummeting. Hyperscalers' returns on AI investments have dropped from 40% down to 20%, and right now they're projected to head straight down toward 10%. Meaning very, very soon, these tech CEOs are going to be forced to sit in their boardrooms and seriously question if a $1 trillion spending spree makes any sense whatsoever for such incredibly limited returns. That looming realization by tech CEOs leaves us facing two very distinct possible futures for late 2026 or 2027. Section 5. The two scenarios: contained versus contagion. Basically, we have two scenarios on the board here. In scenario 1, The Korean crash just remains a localized, contained event. The US tech giants ignore the falling returns, they keep spending hundreds of billions through 2027, and the markets recover. Happy days, right? But scenario 2 is far darker. In this scenario, Korea was just the first domino, the literal canary in the coal mine. It's a warning that the very second a US hyperscaler cuts their capital expenditures, the most leveraged US market in history could face exactly what Korea just went through. Margin calls, forced selling, a historic doom loop, and in all likelihood, massive government intervention just to stop the bleeding. Ultimately, the major takeaway from our source material is captured perfectly by this idea. The market is currently pricing future AI success as if it has already been achieved. Investors in Korea had absolute, unshakable confidence just 3 weeks before their life savings were forcibly liquidated. Right now, the global market is acting as if AI profitability is already a guaranteed reality. People are completely forgetting the immense historical dangers of heavy leverage in a market that is priced for absolute perfection. So I'll leave you to ponder this as we wrap up this explainer. Considering the rapid, ruthless mechanical devastation we just saw unfold in South Korea, driven by the exact same AI hopes and the exact same leveraged bets we see like here at home, are we blindly ignoring the true structural price of our own AI bubble? It's a question every single investor needs to seriously ask themselves before the next domino falls.